Of course, hello and welcome back to Principles of Accounting 1. Uh, I'm still your host, Dr. B. I think I'm still here. We are in week 6 already. Oh my goodness gracious. This is an 8-week course, y'all. And we're in week 6. We're moving right along. We're moving with gusto, as they say. We're staying busy. You know we're staying busy. This is a busy class. So quickly, I just want to show you where we are in the classroom and what's going on, what's where we're all at. So week 6, wow. Yeah. So the 25th through the 1st of October, which is coming up this Sunday. So what's going on in week 6? I want to bring you to the Engage and Explore area. So we have another certificate to get through, the Financial Accounting Part 2. Certificate. This is a good one. I really like the way that these LinkedIn Learning certificates are designed, and I hopefully you find some use in watching those short videos. I really find them to be very insightful, and of course you get to add it to your LinkedIn profile, and you even get a nice grade for it. So hopefully you're finding those to be engaging as you're exploring. So yeah, I personally like those, and hopefully you do as well. So we have the Financial Accounting Part 2 certificate that's due on Sunday night. I know that some of you have done it already. Thank you for that. I appreciate you working ahead. I know that you all have a lot going on in life. You got your work, your school, your family, your kids, all that awesome stuff in life that keeps you busy. But I do appreciate some of you have worked ahead, and that's totally fine. Again, I encourage you to do so. So yeah, this Sunday night you have Financial Accounting Part 2 learning a LinkedIn Learning Certificate, just like the other ones that you've been doing. And then we have the quizzes for Chapter 11 and Chapter 12, which will also do this Sunday night. So as always, you got 3 things. Yeah. So let me know if you need help with that or if you have questions about all that. So in week 6, yeah, it's moving along. So what does that mean for us? Well, there's 2 weeks left after this for this course. We got week 7 and then week 8. At the end of week 8, we have the final exam for the course. As always, there's 2 chapters for pretty much each week. Yeah. So today we're going to do 11 and 12. And then we'll do 13, 14, and then 15, 16, and then we're done. So yeah, there's not much time left. So I just want to let you all have an understanding of where we are in the classroom and what's going on. So let's go ahead and jump into our discussion on liabilities and payroll. And I was just mentioning that this is an interesting one, especially for. Let me just fix the display. This is an interesting for those of you who are working in HR or eventually looking to work in HR. And the reason for that is because we're going to be talking a lot about payroll, which is an HR function. If you're working in HR, you're processing payroll more than likely. And so we're going to dive a little bit deeper into that. And for those of you who have an interest in what goes on with your paycheck, you'll find this part to be interesting as well. So we'll talk about a couple different liabilities, some that you know about, some that you don't know about, and we'll also talk about payroll. So before we jump into the discussion, who can remind me, what is a liability? What's a liability? Who can remind me? What is that? What's a liability? Now you know this. What's a liability?
What you owe?
Mm-hmm. You got it, Leland. It's what the company owes. We owe payment to someone else. So that's a liability. What is a current liability?
A liability that you owe, that's less than a year.
Correct. That's absolutely 100% correct. We owe the liability within 12 months or less. This would include things like accounts payable, wages payable, taxes payable. All of those things are current, what we call current liabilities. We owe them in less than a year. There's also what we call the current portion of long-term debt. There's also what we call uh, short-term notes payable. That's kind of like a short-term loan. Those are all current. It's less than a year. We owe it less than a year. And then we have what's called long-term liabilities. And just as the name implies, it's longer than a year. So these would include things like a mortgage. It would include things like a car loan, a mortgage, a long-term note, right? A bank loan that's longer than a year. What's those things? Student loans. We usually owe those longer than a year. So all of those are long-term liabilities. So short-term liabilities, it's less than a year. We owe it in less than a year. Long-term liabilities, greater than 1 year. Okay. And of course, we have past, present, and future liabilities, right? Past, they've already taken place. Present, we got it going on currently. And then future, payments we need to make in the future. Yeah. So current liabilities are things that the business owes within 1 year or less. Accounts payable, wages payable, taxes payable. These are things we owe in less than 1 year. Current portion of long-term debt, etc. Now we have long-term liabilities, greater than 1 year. This would include things like long-term notes payable, mortgage, other long-term notes payables, like a car loan, etc. Greater than 1 year. We have an example of a couple of very large, well-known companies that and the amount of their current and long-term liabilities. So interesting. A lot of it has to deal with the type of company that it is. Like, for example, a retailer, it's pretty common for a retailer to have a lot of current liabilities and some long-term liabilities. Reason for that is because a retailer likely purchases their inventory from their distributors on accounts payable. Yeah, very common. Oh, they'll pay the vendor 30 days, 45 days, 60 days, whatever. Then, of course, they also have some long-term payables like leases on the buildings, on the spaces within the shopping malls, etc. And then, that's what typically makes up a retailer's liabilities. And then we have other business services here. We have Bowl America. It's a bowling company. Actually, I don't even know if they're still in business. Facebook, which is now Meta. Six Flags. I suspect that their liability is a lot bigger than that. But yeah, it's interesting to see how they all break out. So with liabilities, we know a couple of things, and sometimes we don't know a couple of things. You receive a bill in the mail, that's a current liability. Oh, I got the Pepco bill. I owe that within 15 days, 45 days, whatever. It's current. It's a current bill, current liability. It's for the electric. And I know everything about it. I know when it's due. It's got a due date on it. I know who I'm paying it to, Pepco. And I know how much to pay. It says amount due, right? That's a known liability. We know about it. But sometimes we don't know all those details. The company might receive a bill in the mail for $100, we'll say, and it's due on March 15th. But it's not necessarily clear who to pay it to. Here's what I mean by this. Sometimes you get a bill in the mail for the company. It came from someone else and it's due to someone else. So therefore, it's uncertain of who to pay. It came from a billing company, we'll say, and it's due to a vendor. So that's why you got to read those bills real carefully, because it's not always you're paying it to that same company that it came from. Yeah. It's kind of like when you write on the check that you're sending. Well, I mean, some of you are too young to know what a check is. A check is a document. You fill it out. It's got like a pay to and an amount, and you got to sign it and you got to put it in the mail. Okay. Some of y'all are too young to know that. But for y'all that know what I'm talking about, when you fill out a check, you got to be real specific of who you're paying it to, right? You got to be real specific about the amount and the date of the check. Yeah. It's important to know as much as you can about the liabilities. Sometimes you don't know when it's due. Here's what I mean by that. A while back, we talked about this concept called 210 net 30. Right? You remember that? It's when the business receives a discount of a percentage if we pay within a certain amount of time. Otherwise, the whole thing's due within 30 days or whatever. When that happens, it creates uncertainty of when to pay it. Well, do I pay it in the first 10 days or do I wait for the whole 30 days? Right? Uncertainty. Which also leads into the third part, uncertainty of how much to pay. Well, if I received a bill for $100 and they said, hey, if you pay this $100 bill within the first 10 days, you get a 2% discount. Well, how much do I pay then? If I pay it in the first 10 days, then 2% less. So it'll be $98. So much I'll pay. But if I don't, then the whole $100 due. So uncertain of how much to pay. So or sometimes you'll receive a statement, which is sometimes even worse. You receive a statement from one of your vendors that you make a lot of purchases from. And there's a couple of different amounts there. There's the current amount, there's the total amount, so statements can be confusing sometimes, especially when you make a lot of purchases. Example of this. Back in the early days when I was working in the hotel business, Cisco, huge vendor of ours. Cisco, they deliver a lot of different products, paper goods. They do paper goods, food products, you name it. Like a huge vendor, big distributor, Cisco. And I would always get the statements in the mail every couple of days from them, and it's just like it's so hard to track your accounts payable sometimes, because when you order a lot of stuff from the same vendor, it's like, well, how much do I owe them? It's like it's hard to keep up, and especially in that type of environment where you're going through the product so quickly. It's just like, man, I don't even know what my inventory looks like, and I haven't even paid the bill for it yet. So it creates some uncertainty of how much to pay. So I brought that example up. So the first thing we do is we figure out what is known, and then we figure out the unknowns. So what are known liabilities? These are liabilities that we know that we have to pay. Accounts payable. Yeah, I got to pay my bills. And I know who to pay, how much to pay, and when to pay them. Sales tax is payable. I made sales. I got to pay the tax. I received the tax from my customer. Now I got to pay that tax to the tax agency. Okay. Sales tax payable. It's a known liability. I collected the sales tax. I know I got to pay that same exact amount to the tax agency. Unearned revenue. I know I received payment from my customer, but I also know that I did not send them the good or the service yet. It's a known liability. Unearned revenue. Notes payable. I know I took out a loan from the bank, and I know I have to pay that every single month for X number of months or years. Payroll obligations. My employees are working a set number of hours every week, and they get paid the same amount of money per hour that they work. That's a known liability. And then, of course, there's multi-period known liabilities. I know I have to pay rent every single month at the first of every single month. Okay. These are what we call known liabilities. The company knows about them. We know that they're coming up, and we know we have to pay. Known liabilities. We'll talk about the more unknown stuff here in a little bit. So let's break down the individual ones. We're using a couple of examples, of course. So on August 31, the company, in this case Home Depot, sold materials for $6,000 to me, the customer. There's a 5% sales tax that I had to pay to Home Depot. So what does Home Depot do on their side? Well, they debit cash for $6,300. Why the extra 300? That's the sales tax. That's 5% of 6,000. So 6,000 times 0.05 is 300. Then, of course, we credit sales 6,000. Why 6,000 and not 6,300? You might be wondering. Because they sold $6,000 worth of stuff, not 6,300. 6,300 is the amount of cash that they received. They sold 6,000. The other 300 is the tax. So sales tax payable, we credit that 300. Unearned revenue. The customer paid us in advance. We have not yet provided the good or the service. In this case, Selena Gomez, one of my favorite music artists. She performed a concert on October 31st. But you better believe she sold that concert out in advance. Okay? So, here's how it works. She sold $900,000 worth of tickets for 3 concerts. I'm sure it was more than that, but just to keep things easy. So on June 30th, she sold $900,000 worth of tickets. So she debits cash, $900,000. Credits unearned ticket revenue. Why unearned ticket revenue? Because she hasn't performed the concerts yet. She's got 3 concerts. She brought in $900,000. She performs one of those concerts on October 31st. She's debit unearned ticket revenue, $300,000. Why $300,000? Because the total amount was $900,000 and there's 3 concerts. So for each concert, she's going to debit unearned ticket revenue $300,000 and credit ticket revenue $300,000. Make sense? All right. Okay. Now we know about the known liabilities. We know how adjusting entries work. We've been talking about the accounting cycle for a couple of weeks. We got all that stuff down. Now we're going to talk about a couple of other liabilities that maybe we don't know a whole lot about. So the next one we're going to talk about is called short-term note payable. You're somewhat familiar with this because we talked about this last week, only it was from a different perspective. Remember our customer, Jay Kent, from last week? He kind of, disappeared on us. We got a little upset because we weren't able to collect from him on his current, account receivable. So we decided to convert Jay Kent's account receivable to what we call a note receivable. Remember that? We did that last week. This same concept applies when it comes to notes, or I'm sorry, accounts payable. Sometimes the business, us, we might get a little behind with our vendors. It happens, especially in big businesses. We got a little behind with Cisco at the hotel, for example. This really happened. So the example here is we owed Cisco a lot of money. And Cisco's like, hey, Dr. B. I wasn't a doctor back then because I wouldn't, I wouldn't have gotten us in that kind of trouble. So what happened was Cisco sends us a letter. They said, okay, here's the deal. You guys are behind 6 months on your accounts payable. Says, well, okay, what do we got to do? What they did is they converted some of our account payable into what we call a note payable. So that means that I had to sign a promissory note that said, yes, I'm sorry, I know that we're late. I will pay you in 60 days this amount plus interest. Yeah, works the same way with payables, right? So, promissory note, I'm going to pay you X amount plus interest at a certain amount of time in the future. This happens from time to time, right? Especially with larger businesses. So, here's the example. August 23rd. We asked our vendor, McGraw, say it's McGraw Hill, right? The book company. We asked our vendor, McGraw Hill, to accept $100 in cash today and the rest of our account receivable in the future. Okay, we owe them $600 total. We owe them $600 total. We'll give them $100 today and $500 in the future, plus 12% interest due within 60 days. Okay, so McGraw Hill comes back and they say, yeah, no problem, Dr. B, you can do that. And that'll satisfy our outstanding account payable. So here's how it works. We debit account payable for McGraw Hill, $600. We credit cash, $100, because we're giving them that cash up front. And we credit note payable, McGraw Hill, $500. What that does is it converts the remaining balance into a note payable. So we're coming up on our 2 months, 60 days. Okay, I owe them that $500 plus interest at that 60-day mark. In this case, October 22nd. So we pay McGraw Hill the face value of the note, $500 plus interest, 12%. So how do we calculate the interest? We take the face value, $500, times interest rate, 12%, times time. You remember? We talked about this briefly last week. You'll notice it says 360 days. And I can already hear you, Dr. B, there's 365 days in a year. Yeah, I know that. But there's only 360 banking days in a year. Remember, banking days. We talked about this last week. So here's how we calculate this. Face value times interest rate times time. Do the time first. It's the number of days of the loan, in this example, 60 days, divided by 360 banking days in a year. So 60 divided by 360, we do that part first. Times the interest rate times the face value gets us $10. Okay, $10 is our interest expense. So we debit notes payable, 500. Debit interest expense, $10. Credit cash, 510. That satisfies our note with McGraw-Hill. Let's look at the rest of it. September 30th, we decided to borrow a loan from the bank of $2,000, short-term loan. Yeah. At 12% interest for 60 days. This will get us through purchasing a little bit more than we need in order to satisfy some customers, right? That's what we're going to use the money for. So I debit cash, $2,000, to represent the cash I borrowed from the bank. And I credit notes payable, $2,000, because I owe the bank $2,000. And my note is $2,000, 60 days, 12%. Okay, so the 2 months goes by. Now I got to pay the bank. So I debit notes payable, $2,000, to pay the face value. And I debit interest expense, $40. How 40? Face value times the interest rate times time gets you $40. 2,000 times 12% times 60 over 360 gets you $40. And I debit cash, $2,040. Yeah. Very similar to what we learned about last week. The only difference, of course, is last week was about notes receivable, this payable. So what about when it goes over 2 periods of time? As you know, an accounting period can represent a month, a quarter, semi-annual, or annual. Now let's say this loan is over 2 years. Like, for example, I borrowed the money in December, and I'm going to pay it in February. That's 2 different accounting periods. So as we learned about with adjusting entries several chapters ago, we have to make adjusting entries when that happens. So here we have an example. On December 16th, the company borrowed $2,000 from the bank at 12% interest for 60 days. We got to make an adjusting entry to represent the interest expense that goes into that year that we borrowed the funds. Yeah, the matching principle. So we debit interest expense, credit interest payable. In this example, $10. Why $10? Face value times the interest rate times time. In this case, the time is 15 days. December 16 to December 31. So $10. Then the whole loan is due February 14th of the following year. So on February 14th of the following year, we debit interest expense 30. Why 30? 2,000 times the 12% interest times 45 days over 360. Why 45 days? Because we already recognized the 15 days in the prior year. Right? Gets us an interest expense of $30. So 30, debit interest expense 30, debit interest payable 10, because we're paying the interest from the previous year plus the interest from this year together, right? We debit notes payable, face value 2,000. We credit cash because we're paying cash, $2,040 to the bank on February 14th. Makes sense? Everyone's clear about this? Any questions so far? We're doing okay?
Doing good, Professor.
Awesome. Thank you, Leland. Appreciate it. All right. So we talked about the other kinds of payables briefly. We talked about all the current payables. Now let's talk about payroll. Payroll is how we pay our employees. Okay? Real simple. We have to pay our employees. The employee works for 2 weeks or a week or whatever. Then next week, we're paying them for the time that they worked. We take their hourly rate times the amount of time that they worked. Sounds straightforward. There's a little bit more on that, as you would expect. So let's talk about it. So, payroll liabilities. It's not just the wages. It also includes things like benefits, like pay time off, family leave, FMLA. It includes things like retirement, dental, medical, whatever. All kinds of benefits out there these days. So payroll includes the wages, the benefits. Oh, and don't forget the taxes. Plenty of taxes to pay. Both the employee pays taxes and the employer pays taxes. And we're going to break those taxes down, okay? Because they all get remitted differently. Let me explain it. So take a look at your paycheck. Hopefully you all have made a paycheck at some point in your lives. If you haven't, you will. Okay, hopefully you have. So we start with what's called the gross pay. Gross pay is a very simple calculation. It's your hourly rate times the amount of time that you worked. That equals your gross pay. Your hourly rate times the amount of time that you worked. That equals your gross pay. If you're on salary, it's even easier, okay? Gross pay is what you would make without taxes. So that's gross pay. Then we got to subtract all the fun stuff. So the first thing that comes out before any of these taxes and all that jazz is any kind of employee benefits. Minus whatever. Contributions to your retirement. Gross pay minus contributions to retirement minus whatever's benefits. Then, after that, we start subtracting out all of the taxes and other contributions. So gross pay minus any pre-tax benefits like retirement. And then minus federal income tax. This is the amount that we pay to Uncle Sam, the IRS. Okay. Federal taxes, IRS. Then we take out the percentage that we pay to the state of DC, or whatever state you happen to live in. And then there might be what we call a local tax. For example, if you live in the state of New York and you reside in New York City or in the city of Yonkers, you have a separate local tax that you pay to that jurisdiction. It kind of sucks, to be honest, but that's just my opinion. So federal tax, then state tax. They're both based off of percentages, right? The federal income tax rate, whatever bracket you fall into, and then the state tax rate, whatever bracket you fall into, right? And then there's these other taxes that come out of your check, right? There's your Social Security which is kind of like a government designed benefit that you get to collect from when you get older. And then there's the Medicare, right? Which you get to collect from when you're older, after the age of 62, 65, something like that. Anyway. And then minus any voluntary deductions like charitable giving, that kind of thing. Oh, and then, of course, other voluntary but not voluntary deductions like child support or, any type of garnishments. And then you get to net pay. The net pay is whatever's left over that actually goes into your bank account, right? But that's how it works. Yeah. So that's the employee. That's you, employee. Let's take a closer look at these taxes. So you pay Social Security and Medicare. As of 2020, the Social Security rate is 6.2% of your income. For Medicare, it's 1.45% of your wages. Yeah. These get remitted through the Internal Revenue Service. The employer also has to pay taxes. I'm sure you know that, though. The employer matches your payment to Social Security and to Medicare. So you pay half, and your employer has to pay half as well. They match it, up to a certain amount. And then, of course, the employee also has to pay federal taxes to the IRS, and then the state and local taxes to the state that you're in. DC government, they get their cut, don't worry. The amounts withheld depend on the employee's earnings, taxable rates, and the number of withholding allowances. When you were first hired by the company, you filled out what's called a W-4 form. The W-4 says it designates the amount of deductions and withholdings. For example, some of you might have children or you might have other dependents. We count them so that way the governments take out less money from your taxes. They withhold less. And that helps you to help pay for your dependents. That's the idea behind the W-4. Okay? The employers, what you don't know, also have to pay these kinds of taxes. The difference is the employer doesn't pay the same federal income tax or the state tax that you pay. What the employer pays is what we call FUTA and SUTA, federal unemployment tax and state unemployment tax. Those are the taxes the employer pays. You don't pay those, the employer does. So that's why if you ever become unemployed and you're eligible to collect unemployment, that amount that you're collecting, that was paid into the account from your employer. That's where the money came from. Didn't come from the magic tax fairy. It came from your employer. Employees also have voluntary deductions. This includes things like medical, dental, vision, pensions, which are a form of retirement, 401k, union dues, charitable giving, etc. Everything that comes out of the employee pay for other things. The voluntary deductions. So let me show you an example of the employer's side. So what does the employer have to do in order to pay their employees? Well, employer has to withhold all of those taxes that the employee is paying. And then the employer takes that tax money and remits it to the tax agencies, to the IRS and to the state. So here's an example of a journal entry that would make for a single employee. Okay. So our employee earned $2,000 for working for 2 weeks. Okay, great. So here's the journal entry we have to make for the employee. We debit salaries expense, 2,000. We credit Social Security payable, 124. How 124? It's 2,000 times 6.2%. Medicare taxes payable, 1.45% gets us to $29. Employee federal income taxes payable, 213. We're making this part up. Okay, because we don't know what their percentage, their bracket is. Medical insurance, $85. Union dues, $25. Salaries payable, $1,524. The salaries payable is the amount that the employee will actually receive. That's the net pay, $1,524. So then, February 1, we pay our employee, debit salaries payable, $1,524, credit cash, $1,524. Makes sense? Any questions? I'm sorry, Leland, what was that?
Did you say the last part? I missed the last part.
When we paid our employee?
Yeah.
Yeah. So we debit salaries payable, 1,524, and credit cash, 1,524.
Okay. Yeah. Okay. Yeah, it's right there. I thought you said something else.
No, you're fine. It's all right. Sometimes I talk a little fast or mumble a little bit.
No, you're all right.
All right, cool. Awesome. Thank you. Okay. Yeah, it's relatively straightforward, but it's important to know what comes out of your paycheck and how it works from the employer's side. So, in addition to this stuff, the employer pays, as I mentioned before, federal unemployment tax and state unemployment tax. Instead of the federal and medical, instead of federal and state insurance taxes, the employer pays the unemployment taxes. That's a separate entry. We're going to talk about that here in a second. So the employer, as I mentioned, they match your Social Security and your Medicare. So whatever you pay is what they also pay for Social Security and Medicare. The difference here is the unemployment tax, because the employer has to pay federal and state unemployment taxes. So I'm looking at, here it is. So federal unemployment tax rate, 6% on the first $7,000, and then it goes up, it goes to 5.4% thereafter. Yeah, so it's a kind of a funky calculation, but this is what the employers pay. Yeah. The employer also pays state unemployment taxes, 5.4%, and then there's a match after that. Again, the idea behind these unemployment taxes that the employer pays is in the event that you become unemployed and you're eligible for unemployment taxes, this is what you would collect. Up to a certain amount, of course. So, an example of the payroll entry based off of our earlier example from the $2,000 that our employee earned for the gross pay minus all the taxes. based off of that $2,000, this is the amounts that we would pay for that the employer has to pay. So we debit payroll tax expense 273. How we got 273? Well, we took 124 of that was Social Security. We're matching what the the employee paid. We're also matching the $29 from Medicare that the employee paid. And then we're paying unemployment taxes. It's the gross pay amount times 5.4% for the state unemployment. And then for the federal, it's 0.6%, which is $12. So with HR, HR, is responsible for hiring employees and, making sure that their payroll is kept up, and all of those fun things that HR does. Payroll is a huge part of that. So there's really four activities that HR is responsible when it comes to payroll. Hiring the employee, preparing the payroll, managing the time cards, employees punching in and punching out and recording their time. And then, of course, paying the employee. Yeah, these are the functions that HR plays for payroll. So that's payroll. Now let's switch gears a little bit and talk a little bit more about those other liabilities that the business has to pay. This includes things like unearned revenue and long-term notes payable, or just also known as notes payable. So as you know, unearned revenue is when we have collected payment from the customer, but have not yet provided the goods or the services. It's unearned revenue. Sometimes it could be more than one accounting period. And when that happens, we recognize it as unearned revenue, and it's what we call a multi-period event. If it's longer than 1 year or goes into more than 1 year. The same with notes payable. Notes payable is when we owe for something. The company owes payment for like a car loan or a mortgage or whatever. It's multiple years. It's long term. Okay. Now, sometimes, depending on the type of business that you're in, you might also have more of an estimated liability. Here's what I mean by that. Warranties and bonuses and pensions and health care and vacation pay. All of these are not necessarily known. Like the amount's not known. I don't know. I don't know when my employee's going to take vacation. All I know is that I accrue a liability for that employee when they do take vacation. I've paid it. Yep. Or when the employee retires. I don't know when they're going to retire. And I really don't know the amount that they're going to collect. I have to estimate it. Right? Or if I have a customer that has a warranty claim, example of a warranty. I'm going to give you a real life example. This just happened to me recently. Purchased a television soundbar from Samsung. Soundbar broke. Okay, less than a year I've had it. The manufacturer, Samsung in this example, has a manufacturer's warranty. Meaning, if it breaks within less than a year, they'll come and fix it. Okay, great. So I recently had that happen to me. I had to call Samsung and say, hey, your shit broke. Come and fix it. So they come down, they tried to fix it. They screwed up. They'll be back soon, next week. But this goes toward their warranty liability, right? For Samsung, they have to obviously pay for the cost of the repairs and the service. But they don't know if that's going to happen, so they estimate it. So let's walk through these. So estimated liabilities is when we estimate the possibility of something happening, like an employee retiring, an employee needing health care, going on vacation, or if a customer is claiming for a warranty. We estimate for these things to happen. We have an idea that it's going to happen, so we estimate for it. So, healthcare and pensions. Employees need healthcare, medical, dental, life insurance, disability insurance, etc. So here we have an example. The employer pays a certain amount for medical insurance and also contributes a percentage toward the employee's retirement program. Yeah. In this example, $8,000 a year the employer pays toward the medical expense for the employee. And they also pay 10% toward their retirement. That's a nice benefit. It's more than me. So here we have the journal entry that we make at the end of each year that the employee is working there. We debit employee benefits expense. In this example, $20,000. We credit employee medical insurance payable, $8,000, which is the maximum. And then we credit employee retirement program payable, $12,000. How $12,000? The employee makes $120,000 a year. 10% of that we contribute to their retirement. So $12,000. That's where the amount came from. I'm such a great employer that I even give my employees vacation benefits. That's a nice benefit. So let's assume I have an employee that earns 2 weeks of paid vacation every single year. Man, that's a real nice benefit. So I debit vacation benefits expense, $3,200. And I credit vacation benefits payable, $3,200. My employee, working so hard, decided to take a couple days vacation. Great. So when they take the vacation, we debit vacation benefits payable, $400. Credit cash, $400. Bonuses. Oh man, if you get a bonus, it's great. Okay. Employees love bonuses. It's just extra money. Company paid us extra money for whatever reason. Cool. Let's assume that we pay a bonus of $10,000 to our employees to be shared by all. That's not as good. Okay, we debit employee bonus expense $10,000. We credit bonus payable $10,000. At the beginning of the year we'll pay them bonus. Okay, the warranties. Manufacturers oftentimes offer a 1-year limited parts and labor warranty. They say, hey, I guarantee my stuff is going to work. If it don't work, I'll fix it, repair it, or replace it through the warranty program. Okay, most things that you buy probably have a warranty like this. Yeah, warranty is about a year, covers parts and labor. If it breaks within a year, you contact the manufacturer and they take care of the service and the parts. That's what a warranty is. Okay, that's how it works. So how does it work from the company's perspective? Let's say a car dealership sells a car for $16,000 with a 1-year warranty or 12,000 miles, whichever comes first. Covers parts, probably labor. Based off of past experience, the company estimates that 4% of the car's sales price will be warranted. So we estimate this. We debit warranty expense $640. How 640? 16,000 times 4%. We credit estimated warranty liability 640. Then let's say one of those customers that we sold that car to has a claim. It broke down within the year. What'd you guys do? What'd you sell me? So they bring it back to the dealership and we repair the car for them. Okay, no problem. It's on a warranty. The part costs $200. So we debit estimated warranty liability, $200, and we credit parts inventory, $200. Remember, it's the dealership. So that's how warranties work. Any questions on warranties? Okay. All right. So I had mentioned, the estimate part. It's like, how do you estimate a warranty? We estimate it based off of the contingency. We call this a contingent liability. Contingency is the possibility of something happening in the future. Okay, what's the possibility of it? For contingent liability, we estimate. Okay, for example, what's the possibility of my company getting sued? If it's a remote possibility, I don't disclose anything. I don't even put it in my notes. If it's possible, I have to disclose that to my investors. Yeah. If it's probable, we'll probably get sued. Then I have to go through the process if I should estimate it or not estimate it. If I estimate the probability that I'm going to get sued, I have to put that into the liabilities as an estimate. If not, I just put it in my notes. See, that's what we call a contingent liability. Things include like potential legal claims, a debt guarantee, and other contingencies. Legal claims, potential that somebody's going to sue you for whatever reason. It's hard to estimate it, so we usually put some type of factor in there. Debt guarantees is this one is like if the company doesn't pay back the liability, doesn't pay back the loan, that debt might sometimes be guaranteed. A guarantee is when there's an asset attached to that loan. For example, with a car loan that you have through the bank, it's guaranteed. How is it guaranteed? It's guaranteed by the car. So if you don't pay the car loan, the bank comes to take the car. That's the guarantee. Same with the house, the mortgage. You don't pay the mortgage, the bank comes take the house. The house is the guarantee. It's what backs it up. In business, sometimes you might have to sign what's called a personal guarantee. A personal guarantee is where you put something up for collateral in the event of a default. Okay. Hopefully it never happens to you, but I just wanted to let you know what it is. Then we have other contingencies like environmental damage, tax liens, insurance losses, government investigations, etc. And then, of course, we have uncertainties. Uncertainties are hard to predict. Sometimes we have to disclose it or not, depending on what it is or what it might be. So, that's contingencies. Any questions on contingencies? I'm sure it's relatively straightforward. Okay. Couple of ratios you need to know about. First is called the times interest earned ratio. Times interest earned ratio is good to know because,
Question.
yes,
I interrupt you.
Leland.
I was going to ask you, what's the difference between an uncertainty and a contingent?
Yeah, great question, Leland.
Difference.
So a contingency is where we might estimate the possibility of something happening. There's a contingency for that. That's what the word contingency means, right? There's a contingency, there's an alternate plan. So, for example, if I, what's the possibility of me getting sued in business? Is it low risk, somewhat possible, or possible? If it's possible, I'm going to put some money aside in a contingency liability account that says, hey, I might get sued. I'm going to use that liability money to pay for that. The other, if it's, that's if it's a contingency. That's what the contingency means. It's money we set aside in the event that something happens. For uncertainty, it's not knowing if something is going to happen in the future, like something like, oh, an angry customer comes around and does something to the business, or oh, you know, the building got hit by an asteroid.
So it's basically it's like no way of planning for something because it's completely out of the realm of like you think it's not really a possibility at all.
Exactly. Yeah, that's what we call an uncertainty. And in that,
In the future.
if it's uncertain, we might put it in the notes, be like, yeah, this might happen, but it probably not. Yeah, exactly. Yeah, good question. So the ratios, it's called times interest earned ratio. Companies use it this one to understand the company's ability to pay back its debt and to understand what the riskiness is. Okay, times interest earned. We take income before interest, expense, and income taxes. And we divide by interest expense. This gives me the times interest earned. Helps me to evaluate the company's risk. Yeah. So here we have an example for times interest earned. We have interest before interest, expense, and income taxes. This is found on the income statement. This example is 150 bucks divided by interest expense, $60. The times interest earned in this case is 2.5. So it's 2.5 times likely of risk. And just to clarify a couple of reports that you might come across in accounting when it comes to payroll. I had mentioned one earlier called the W-4. That's when you first get hired. You complete what's called a W-4 form. It tells you about the your deductions and your withholdings. At the end of each year that you're working, you receive what's called a W-2 form from your employer. And it tells you all of the wages that you earned and all the taxes that were paid and all that fun stuff. And you get to file that W-2 along with your other IRS forms, which could be the 9040 or the 1080 or whatever it is that you're filing. Employers also report what's called the IRS Form 9041 and the 9040. And these tell the IRS about the total taxes that were withheld for the company, for the employees. Other payroll records include things like the payroll register, that's the tracking of all the paychecks that we issue, the payroll checks themselves, the employee earnings reports, etc. And then one of the last things I'm going to tell you about for this chapter is about corporate income taxes. So just like individuals, corporations also earn an income, obviously, and the company has to pay taxes on that income. So these are the types of entries that we would make. Debit income tax expense, credit income tax payable, to recognize the income tax expense. Then, of course, we have to pay that in April. Debit income tax payable, credit cash. And then at the end of the year, we might also estimate our income tax payable. Those are the type of entries that we make. Okay, any questions at all on liabilities or payroll? Liabilities or payroll? Any last questions on that topic?
No, sir.
Okay, awesome. Very cool. So let me switch gears here and we'll talk about the next chapter here in just 1 second. So please stand by while I make the change.